Remember the housing boom? Prices skyrocketing, everyone rushing to buy, convinced it would never end. Then, the crash. The bursting of that bubble, like so many before it, left a trail of financial devastation. This isn't just recent history, it's a recurring theme in the story of market economies. From the Dutch Tulip Mania of the 17th century to the dot-com frenzy of the late 90s, history is littered with examples of markets gone wild. These episodes, often called bubbles, are periods of intense speculation where asset prices soar far beyond any reasonable valuation. But what drives these cycles of boom and bust? What makes otherwise rational individuals get swept up in the frenzy? The answers lie in understanding the psychology of market bubbles. It's about delving into the minds of investors, exploring the emotions, biases, and social influences that shape their decisions. This isn't just about dry economic theory, it's about the very human story of greed and fear, hope and despair, played out on the grand stage of financial markets. By understanding these forces, we can better equip ourselves to navigate the often turbulent waters of investment, hopefully avoiding the wreckage of the next big crash. Join us as we take a deep dive into the fascinating and sometimes frightening world of market bubbles. Imagine a market where prices are steadily rising. Investors, initially cautious, start to take notice. The gains become hard to ignore, and a sense of excitement begins to build. This is the early stage of a bubble, where optimism takes root and a narrative of endless growth emerges. As more investors pile in, fueled by fear of missing out, prices accelerate further. The media amplifies the frenzy, touting incredible success stories and fueling the speculative fire. This is the phase of irrational exuberance, a term famously coined by economist Robert Shiller, where rational analysis takes a back seat to the emotional roller coaster of the crowd. At the peak of the bubble, a sense of euphoria prevails. Everyone is a winner, at least on paper. The idea that prices could ever go down seems absurd. But this euphoria is often the harbinger of the inevitable fall. Eventually, reality sets in. The fundamentals can't support the inflated prices forever. Doubt creeps in and the market begins to wobble. As prices start to decline, fear replaces greed. Investors rush to sell, desperate to salvage what they can. The bubble bursts and the market crashes, leaving a trail of financial devastation in its wake. At the heart of many market bubbles lies a primal human instinct: greed. The desire for wealth and the allure of quick riches can cloud judgment and lead to irrational decision-making. When asset prices begin their ascent, the potential for profit becomes a powerful motivator. Investors, enticed by the prospect of easy money, often throw caution to the wind. They disregard traditional valuation metrics, believing that the old rules no longer apply. This greed is often amplified by the fear of missing out, FOMO. As the market climbs higher, those who haven't yet participated feel an increasing pressure to join the party. They see others getting rich and worry about being left behind. This fear can be especially acute in situations where the market seems to defy gravity, with prices rising at an unprecedented rate. The combination of greed and FOMO creates a potent cocktail that can fuel a bubble to dizzying heights. However, greed alone doesn't explain the full story of market bubbles. If everyone acted solely out of self-interest, bubbles would likely be smaller and shorter-lived. What truly allows these speculative episodes to reach such epic proportions is the power of social influence. Imagine a crowded theater. Suddenly, someone shouts, "Fire!" Even if you don't see flames or smell smoke, you're likely to run for the exits. Why? Because in such situations, following the crowd often seems like the safest course of action. This same instinct, known as herd behavior, plays a powerful role in market bubbles. As prices rise and more investors jump on board, it creates a sense of social proof. People begin to assume that everyone else must know something I don't. This herd mentality can be further reinforced by media coverage. During a bubble, news outlets often focus on the positive aspects of the market, highlighting success stories and downplaying any warning signs. This can create a self-fulfilling prophecy, as increased media attention attracts even more investors, further driving up prices. The internet and social media have only amplified this effect, allowing information both accurate and misleading to spread at lightning speed. As the bubble inflates, dissenting voices are often drowned out. Those who caution against the frenzy are dismissed as out of touch or even envious. After all, who wants to be the party pooper when everyone else seems to be having a good time making money? This suppression of dissenting views creates an illusion of consensus, making it even harder for individuals to resist the pull of the crowd. Section 3. Overconfidence and illusion of control. Another key ingredient in the recipe for a market bubble is overconfidence. During periods of market euphoria, investors often develop an inflated sense of their own knowledge and ability to predict the future. They see past gains as evidence of their own brilliance, attributing their success to skill rather than luck. This overconfidence can lead to excessive risk-taking, as investors become convinced that they can time the market perfectly and get out before the bubble bursts. This illusion of control is often reinforced by the availability of sophisticated financial instruments and trading platforms. These tools, while potentially useful in the right hands, can also give investors a false sense of security and control over the market. They believe that they can manage risk and maximize returns with a few clicks of a mouse, failing to recognize the inherent uncertainty and complexity of financial markets. The dot-com bubble provides a prime example of this phenomenon. Section 4. The narrative trap. Human beings are storytelling creatures. We crave narratives that help us make sense of the world around us. This innate need for narrative plays a significant role in the formation of market bubbles. During a bubble, a compelling story emerges that justifies the soaring asset prices. This narrative often taps into our deepest desires and aspirations, promising a future of wealth, innovation, or societal transformation. In the case of the dot-com bubble, the narrative centered around the transformative power of the internet. Investors were swept up in the excitement of the new economy, believing that traditional valuation metrics no longer applied to internet companies. The narrative was so powerful that even seasoned investors poured money into companies with little to no revenue, let alone profits. This is the danger of the narrative trap. When we become emotionally invested in a particular story, we tend to ignore evidence that contradicts our beliefs. We become so caught up in the excitement of the narrative that we fail to see the warning signs until it's too late. Section 1. Tulip Mania, a Floral Fantasy. Let's journey back to the 17th century to the Netherlands, where a peculiar flower sparked an unprecedented frenzy. Tulips, exotic blooms from the Ottoman Empire, had recently been introduced to Europe, captivating the Dutch elite with their vibrant colors and intricate patterns. As demand for these prized flowers soared, so did their prices. What began as a fascination among the wealthy soon morphed into a speculative mania that gripped the entire nation. People from all walks of life, from merchants to carpenters, mortgaged their homes and invested their life savings in tulip bulbs. The price of a single bulb of a particularly rare variety, the Semper Augustus, could reach the equivalent of a luxurious Amsterdam canal house. Contracts were traded on future tulip harvests, fueling a speculative bubble that seemed to have no bounds. The Dutch, swept up in the frenzy, believed they had stumbled upon a new era of prosperity, one built on the delicate petals of a flower. However, like all bubbles, the tulip mania was destined to burst. As prices reached unsustainable levels, some wary investors began to sell their holdings, triggering a domino effect. The market, built on speculation and fueled by herd mentality, collapsed as quickly as it had risen. Panic ensued as fortunes were wiped out overnight. The once prized tulip bulbs became worthless, leaving countless families financially ruined. The tulip mania, though centuries old, serves as a stark reminder of the power of speculation and the dangers of market bubbles. It illustrates how even seemingly rational individuals can be swept up in a frenzy, driven by greed, fear of missing out, and the allure of quick riches. The lessons learned from this historical episode remain relevant today, serving as a cautionary tale for investors in all markets and all eras. Fast forward to 18th century England, where another speculative bubble, this time centered around a trading company, would leave its mark on history. The South Sea Company, granted a monopoly on trade with the Spanish colonies in South America, became the darling of the investment world. Fueled by rumors of vast riches to be made in the New World, investors clamored to buy shares, driving the company's stock price to astronomical heights. What investors failed to grasp was the precarious nature of the South Sea Company's ventures. The company's trading operations were hampered by conflict with Spain and the logistical challenges of transatlantic commerce. The promised riches remained elusive, but this didn't stop the speculative frenzy. As the bubble inflated, even the British government got caught up in the excitement, issuing bonds and using the proceeds to buy South Sea Company stock, further fueling the mania. However, reality eventually caught up with the South Sea bubble. As doubts crept in about the company's prospects, investors began to sell their shares, triggering a market collapse. The stock price plummeted, wiping out fortunes and leaving a trail of financial ruin in its wake. The South Sea bubble had burst, exposing the fragility of speculative markets and the dangers of investing based on hype and rumor. The South Sea bubble, much like the Tulip Mania before it, highlighted the human tendency to get caught up in speculative frenzies. It demonstrated how a compelling narrative, combined with greed and herd behavior, could lead to irrational investment decisions and ultimately financial disaster. These historical bubbles serve as cautionary tales, reminding us that the allure of quick riches can be a siren song, leading investors astray in any era. The Roaring Twenties in the United States, a period of economic prosperity and social change, witnessed the rise of another major market bubble, this time in the stock market. Fueled by technological innovation, mass production, and a booming consumer culture, the U.S. economy experienced unprecedented growth. This growth, however, was accompanied by rampant speculation in the stock market, as investors, eager to participate in the economic boom, poured their savings into stocks. Margin buying, which allowed investors to purchase stocks with borrowed money, further fueled the speculative frenzy. As stock prices soared, investors felt invincible, believing that the good times would never end. The market, however, became increasingly detached from economic fundamentals. Companies with little to no earnings saw their stock prices skyrocket, driven purely by speculation and herd mentality. The bubble finally burst in October 1929 with the infamous stock market crash. The crash, triggered by a combination of factors, including overvaluation, excessive margin debt, and a loss of investor confidence, sent shockwaves through the global economy. The Roaring Twenties came to an abrupt end, ushering in the Great Depression, a decade of economic hardship and social unrest. The Roaring Twenties and the subsequent Great Depression provide a stark illustration of the devastating consequences that can result from unchecked market speculation. The bubble, fueled by easy credit, overconfidence, and a disconnect from economic fundamentals, ultimately led to a prolonged period of economic hardship. This historical episode serves as a reminder of the importance of sound economic policies, investor education, and a healthy dose of skepticism when it comes to market exuberance. The late 1990s witnessed the rise of the dot-com bubble, a speculative frenzy centered around the burgeoning internet industry. The internet, hailed as a transformative technology, promised to revolutionize commerce, communication, and countless other aspects of modern life. Investors, captivated by the potential of the new economy, poured billions of dollars into internet startups, driving up the valuations of companies with little to no revenue, let alone profits. The dot-com bubble was fueled by a potent mix of technological innovation, speculative fervor, and a belief that traditional valuation metrics no longer applied to internet companies. Investors, caught up in the hype, were willing to overlook sky-high price-to-earnings ratios and non-existent profits, believing that first-mover advantage and rapid user growth were the keys to success in the digital age. However, as with all bubbles, the dot-com frenzy eventually came crashing down. As investors began to question the lofty valuations of internet companies, the market began to unravel. The bubble burst in early 2000, sending shockwaves through the technology sector and the broader stock market. Countless dot-com companies went bankrupt, wiping out billions of dollars in investor capital and leaving a trail of disillusionment in its wake. The dot-com bubble, though relatively recent, serves as a potent reminder of the dangers of speculative excess and the importance of sound investment principles. It highlights the human tendency to get caught up in the excitement of new technologies and the allure of quick riches, often overlooking fundamental factors such as valuation and profitability. The dot-com bust, though painful for many investors, provided valuable lessons about the importance of due diligence, risk management, and a healthy dose of skepticism when navigating the often turbulent waters of financial markets. The bursting of a market bubble is rarely a gentle affair. It's an economic earthquake, sending shockwaves through the financial system and beyond. The immediate aftermath is often characterized by panic selling, as investors, desperate to salvage what they can, flood the market with assets, further depressing prices. This downward spiral can lead to a credit crunch as banks, fearing losses, become reluctant to lend, further exacerbating the economic downturn. The consequences extend far beyond Wall Street. Businesses, starved of capital and facing declining demand, are forced to cut costs, leading to layoffs and wage stagnation. Consumer confidence plummets, sending spending into a tailspin. The ripple effects can be felt throughout the economy, impacting everything from housing prices to retirement savings. The bursting of the dot-com bubble, for example, led to a recession in the early 2000s, costing the U.S. economy billions of dollars and thousands of jobs. The human cost of these economic hangovers can be devastating. Families lose their homes, their savings, and their livelihoods. The psychological toll of financial ruin can be profound, leading to increased stress, anxiety, and even depression. The economic fallout from market bubbles is a stark reminder that these events are not just abstract financial phenomena. They have real-world consequences that impact the lives of millions of people. In the wake of a market bubble, policymakers often face pressure to take action, to prevent a repeat of the speculative excesses that led to the crisis. This often results in calls for increased regulation, aimed at curbing risky behavior and protecting investors from themselves. These regulatory responses can take various forms, from stricter lending standards to increased oversight of financial institutions. Following the 1929 stock market crash, for example, the United States implemented a series of reforms, including the creation of the Securities and Exchange Commission, SEC, to regulate the securities industry and prevent fraud. Similarly, the global financial crisis of 2008 led to the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act, a sweeping piece of legislation aimed at reforming the financial industry and preventing future crises. However, finding the right balance between regulation and market freedom is a delicate dance. Too much regulation can stifle innovation and economic growth, while too little can leave the system vulnerable to another speculative bubble. The challenge for policymakers is to create a regulatory framework that promotes stability and protects investors without stifling the dynamism that drives economic progress. This requires a nuanced understanding of the complex interplay between human behavior, market forces, and regulatory intervention. The bursting of a market bubble leaves more than just economic scars. It also leaves a lasting impact on the collective psyche, shaping attitudes towards risk, investment, and the very nature of economic cycles. The experience of living through a boom and bust cycle can profoundly alter an individual's financial behavior, often leading to increased risk aversion and a deep-seated skepticism towards market exuberance. This shift in sentiment can have long-term consequences for the economy. Investors, once burned by the bursting of a bubble, may be reluctant to jump back into the market, even when valuations are attractive. This can lead to a prolonged period of subdued investment and slower economic growth. The scars of the dot-com bubble, for example, made investors wary of technology stocks for years, even as the industry recovered and thrived. Moreover, the experience of a market bubble can erode trust in institutions, from financial institutions to government regulators. The perception that those in power failed to prevent or mitigate the crisis, or worse yet, benefited from it, can fuel cynicism and distrust in the system as a whole. This erosion of trust can have far-reaching consequences, undermining confidence in the economy and making it more difficult to address future challenges. Section 4. The Elusive Quest for Stability. Despite our best efforts to learn from the past, market bubbles remain a recurring feature of modern economies. The human factors that drive these cycles of boom and bust greed, fear, herd behavior, and the allure of a good story are deeply ingrained in our nature. As long as humans are involved in financial markets, there will always be the potential for speculative excesses. However, this doesn't mean we are powerless in the face of these speculative forces. By understanding the psychology of market bubbles, recognizing the warning signs, and approaching investment decisions with a healthy dose of skepticism, we can mitigate the risks and avoid getting caught up in the frenzy. Education, financial literacy, and a critical understanding of market history are essential tools in this ongoing quest for stability. The challenge lies in finding the right balance between embracing the dynamism of market economies and guarding against the excesses that can lead to their undoing. This requires a continuous process of learning, adapting, and evolving our understanding of the complex interplay between human behavior, financial markets, and the ever-present potential for both irrational exuberance and devastating despair. Section 1. The Unending Cycle. As we've journeyed through history, from the tulip fields of the Netherlands to the boardrooms of Wall Street, one thing becomes abundantly clear. Market bubbles, like tides, ebb and flow in a seemingly unending cycle. They are a testament to the enduring power of human emotions, greed, fear, hope, and despair, to shape the course of financial markets. While the specific assets, technologies, or narratives may change, the underlying dynamics remain remarkably consistent. Each bubble, in its own way, reflects the zeitgeist of its era, capturing the prevailing hopes, dreams, and anxieties of the time. The Tulip Mania embodied the Dutch Golden Age's fascination with exotic goods and newfound wealth. The South Sea bubble mirrored the 18th century obsession with imperial expansion and the promise of trade. The Roaring Twenties and the subsequent Great Depression reflected the transformative power of mass production and the perils of unchecked speculation. And the dot-com bubble epitomized the late 20th century fascination with the internet and its potential to reshape our world. Yet despite these historical lessons, we seem destined to repeat these cycles of boom and bust. The allure of quick riches, the fear of missing out, and the seductive power of a compelling narrative continue to cloud our judgment, leading us down the same well-trodden path of speculative excess. The question then is not whether bubbles will continue to occur, but how we can navigate these treacherous waters and avoid becoming swept away by the currents of irrational exuberance. While predicting the precise timing and magnitude of a market bubble is an impossible task, there are often warning signs that can alert us to the possibility of a bubble inflating. One of the most obvious signs is a rapid and sustained increase in asset prices, particularly when those prices become detached from underlying economic fundamentals. When the price of a tulip bulb exceeds the cost of a house, or when a company with no profits is valued at billions of dollars, it's usually a sign that something is amiss. Another red flag is excessive media hype and a pervasive sense of euphoria surrounding the asset or sector in question. When everyone from taxi drivers to hairdressers is dispensing investment advice, and when news outlets breathlessly report on every uptick in price, it's a sign that the market may be entering bubble territory. This is often accompanied by a suspension of disbelief, as investors, caught up in the excitement, ignore traditional valuation metrics and dismiss any dissenting voices as out of touch or envious. Furthermore, keep an eye out for a surge in leverage and speculative trading. When investors borrow heavily to buy assets, or when complex financial instruments are created to amplify returns, it can fuel a bubble to unsustainable levels. The availability of easy credit and the proliferation of exotic investment products can create a dangerous cocktail, allowing investors to take on more risk than they can handle. By being aware of these warning signs and approaching investment decisions with a critical eye, we can reduce the likelihood of getting caught up in the frenzy of a market bubble. Navigating the often treacherous landscape of financial markets requires a combination of knowledge, discipline, and a healthy dose of skepticism. It's essential to have a sound understanding of investment fundamentals, including valuation metrics, risk management, and the importance of diversification. Don't be swayed by market hype or the fear of missing out. Remember that investment decisions should be based on careful analysis and a long-term perspective, not on emotion or speculation. One of the most effective ways to avoid getting caught up in a bubble is to invest in assets that you understand and believe in, rather than blindly following the crowd. Conduct your own research, ask questions, and don't be afraid to seek out dissenting opinions. If an investment seems too good to be true, it probably is. Remember, there are no shortcuts to success in investing. Patience, discipline, and a commitment to learning are essential traits for navigating the ups and downs of the market. It's also crucial to have a plan and stick to it. Define your investment goals, risk tolerance, and time horizon, and then choose investments that align with those objectives. Don't chase returns or try to time the market. Instead, focus on building a diversified portfolio of high-quality assets that will stand the test of time. And remember, it's always a good idea to consult with a qualified financial advisor to get personalized advice tailored to your individual circumstances. In the midst of a market bubble, it can be difficult to maintain perspective. The constant barrage of positive news, the fear of missing out, and the seductive allure of easy money can cloud our judgment and lead us to make irrational decisions. That's why it's crucial to step back from the noise and remind ourselves that market cycles are a natural part of capitalism. Remember that what goes up must eventually come down. Trees don't grow to the sky, and neither do stock prices. Every bull market eventually gives way to a bear market, and every period of economic expansion is followed by a contraction. This is not a cause for despair, but rather a reminder that markets are cyclical, and understanding these cycles is essential for long-term investment success. Instead of fearing market corrections, view them as opportunities to buy undervalued assets and rebalance your portfolio. Remember that the best investors are those who can keep their emotions in check and make rational decisions, even when the market is volatile. By maintaining a long-term perspective and focusing on the fundamentals, you can weather the inevitable storms and come out ahead in the end. The history of market bubbles is a cautionary tale, reminding us of the dangers of speculative excess and the importance of sound investment principles. While we may never be able to completely eliminate bubbles, we can learn from the past and take steps to mitigate their impact. This requires a collective effort, from individual investors to policymakers, to promote financial literacy, encourage responsible investment practices, and foster a culture of prudence and skepticism. For individual investors, this means approaching investment decisions with a critical eye, conducting thorough research, and avoiding the temptation to follow the crowd. For policymakers, it means striking a balance between fostering innovation and protecting investors, creating a regulatory environment that promotes stability without stifling economic growth. Ultimately, the goal is not to eliminate risk entirely, for risk is an inherent part of any investment. Rather, it is to manage risk responsibly, to invest with our eyes wide open, and to avoid the pitfalls of irrational exuberance that have led so many astray throughout history. By heeding the lessons of the past, embracing a long-term perspective, and approaching financial markets with a healthy dose of prudence, we can navigate the inevitable bubbles and busts and emerge stronger on the other side. Remember, investing is a marathon, not a sprint, and slow and steady wins the race.